Liquidity and financial conditions. That is the next part which I would like to highlight. During the current financial year so far, system liquidity transited from surplus to deficit conditions and then again back to surplus in early June. In consonance with the commitment made in the April policy statement of remaining nimble and flexible in liquidity management, and in view of the shifting liquidity dynamics, the Reserve Bank mopped up surplus liquidity through variable rate reverse repo auctions, that is VRRR auctions, during the first half of April, while injecting liquidity through variable rate repo operations, that is VRR operations, in the latter part of April and in May. In the first week of June, however, VRRR auctions have been conducted. Banks' recourse to the marginal standing facility, that is MSF, under the liquidity adjustment facility remained low during 2024-25, that is in the current year so far. Now, mirroring the liquidity dynamics which I just explained, the weighted average call rate, that is WACR, on an average remained close to the middle of the corridor. Now, I have explained, for common listeners and for others, I have explained what exactly the corridor means in the footnote. And let me also state here that most of the statements which I am making are backed by data, and the data is given in the footnotes, and I would encourage you to have a look at footnotes to understand why we are making certain statements. So mirroring the liquidity dynamics, as I said, the weighted average call rate, that is WACR, on an average remained close to the middle of the corridor. Across the term money market segment, the yields on certificates of deposit, that is CDs, commercial papers, that is CP, issued by non-banking financial companies, that is NBFCs, and 3-month treasury bills, that is T-bills, also eased. In the credit market, monetary transmission remains ongoing. As you would be aware, the Central Board of the Reserve Bank decided to transfer rupees 2.11 lakh crore as surplus to the central government for the accounting year 2023-24. As the economy remains robust and resilient, the Central Board decided to utilize this opportunity to increase the risk provisioning under the contingent reserve buffer to 6.5% of the Reserve Bank's balance sheet for 2023-24 from 6% in 2022-23. In other words, the contingent reserve buffer, which was 6% in 22-23, was enhanced by the Central Board to 6.5% in the current for the year 22-23. Now, this risk provisioning, that is this provision for contingent reserve buffer, or CRB as we call it, this would further strengthen the Reserve Bank's balance sheet. Prudence is at the core of our standard operating procedure. The Indian rupee moved in a narrow range with a low volatility during 2024-25 so far. That is up to June 5th, and that's the figure I have given. Now, this has happened despite the rupee trading under pressure amidst foreign portfolio, that is FPI outflows. The relative stability of the Indian rupee bears testimony to India's sound and resilient economic fundamentals and its macroeconomic and financial stability and improvement in the external outlook. Looking ahead, the Reserve Bank will, and I'm providing some kind of a forward guidance here with regard to liquidity and our approach to the markets. Looking ahead, the Reserve Bank will continue to be nimble and flexible in its liquidity management through main and fine-tuning operations in both repo and reverse repo. We will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner which preserves financial stability. As our actions over the recent period have shown, the Reserve Bank stands committed to maintain stability and orderliness in all segments of financial markets and institutions regulated by it. I would like to read this sentence once again for clarity. And it's not just for clarity, but to reiterate the position. As our actions over the recent period have shown, the Reserve Bank stands committed to maintain stability and orderliness in all segments of financial markets and institutions regulated by it. And this is consistent with our approach, which we have been adopting. Even during COVID times, we adopted the same approach, and thereafter we have continued. So therefore, our focus is to ensure stability and orderliness in all segments of financial markets and institutions which are regulated by the Reserve Bank.